one of my largest positions is JD.com. And as you can see from this stock chart, in 2018, especially in the second half of 2018, the company got absolutely crushed in the stock markets. And I had started purchasing JD in the middle of 2018, and in the later part of 2018, I stepped on the gas and I started accumulating huge number of shares. So JD became, in percentage terms, one of my largest holdings. Now, as you can see from JD's income statements, they have been declaring operating losses for all these years, and 2018 the losses accelerated. In fact, it was a bad year for JD, not only in terms of their operating performance, but also their CEO got into some kind of trouble, and everything put together just hammered the stock price. But how did I manage to stay calm, and why did I continue to accumulate JD.com? So in this video, I'm going to discuss 3 of those insights which were the source of my conviction. So the first source of my conviction came from JD's cash flow statements. Now, you will see JD has a very high D&A, the depreciation and amortization expense. So this is a non-cash expense. So it gets added back to the net income or the net loss in this case. But I'm going to discuss that at a later stage. But here what I found much more interesting is JD's change in working capital. So that has been a huge source of cash flow for JD over the years. And this picture shows you the entire block, the change in working capital, which contributed to the cash flows. So I have summarized the figures here, and as you can see, just the net working capital change component, this is a component of the operating cash flows, just this has been large enough to pay for JD's capex spend. In fact, in 2015 it has been almost same. In 2016 it was the net working capital increase where JD released almost 7.5 billion renminbi. This was much more than the capex spend, and so was the case in 2017. So is this sustainable? I mean, where did this money come from? Now, this is an extract from an analyst report, and he actually has been following JD very, very closely, and I respect his views and his writings. But he has actually pointed out a risk. I had a slightly different insight. Now, while it's true that the going will be great until the sales decline, and it's common knowledge that change in working capital, while it can throw up some cash if the company is liquidating its working capital, but that's never a sustainable source of cash. You are much better off depending on actual sales growth. But specifically in case of JD, there is another very important factor, and this comes out from their very business model. Now, this factor is the mix of sales that JD has between their first party sales and their third party sales. What is third party sales? Is basically the third party merchants who are selling on JD platform. Now, JD's negative working capital situation not only improves due to its growth in sales, which we all agree that at some point of time the growth will slow, right? But this negative working capital situation also improves due to the increase in percentage of GMV coming from third party sales versus the first party sales. And this is a very strong trend which is unlikely to change anytime soon. Now let me explain the difference in terms of working capital a bit. Now when JD is selling as a first party seller on its platform, so JD would have bought the goods from their suppliers and they would have got some kind of credit. So that results in the payables days. And JD being such a large company, I'm sure they get very good credit. So the payables days would be high. But then JD is also carrying a lot of inventory. So the inventory days are also expected to be high. And JD is unlikely to have too much receivables. Now, in case of third-party sellers, the inventory immediately becomes zero because the inventory risk belongs to the third-party sellers. So the number of days in terms of inventory days immediately becomes zero. However, the payables days actually shrink because here JD needs to pay to the third-party sellers much faster. But the combined effect of this zero inventory and lower payables days, that results in a much more negative working capital situation. And this picture actually demonstrates that. So the first column is the existing figures from 2017, and we have just replicated the figures here, and we see that the net working capital, which is the absolute value as a percentage of GMV, is 2.41%, and the net working capital is negative. We have taken two different scenarios just to demonstrate the effect of a higher percentage of third-party merchants on the net working capital situation. So in scenario 1, we have added another 25% to the gross merchandise value. And we assume that this additional 25% has come from third-party merchants. Here we are exaggerating the figures just to explain the point. And because of this higher percentage of third-party sellers, the net working capital as a percentage of GMV has gone up to 3.72%. So essentially what this means is, if on JD's platform you only have third-party merchants, as we have in scenario 1, then the net working capital, the absolute value of the net working capital would be a higher number. And the net working capital as a percentage of the GMV will be a higher negative. So essentially JD will need even less working capital because this is a negative figure, remember. So essentially JD will need even less working capital. So what is the combined effect if we add this scenario 1 to the existing figures of 2017? What will be the combined effect of this additional percentage of third-party sellers on the net working capital? Will JD need more net working capital or will JD need less net working capital? We can see that the net working capital percentage is going up to 2.67. But remember, this is a negative figure, which means JD's net working capital situation is becoming even more negative as a percentage of the GMV, which means JD will need even less net working capital. Now in scenario 2, we have exaggerated the figures even further and we have added another 50% to the 2017 GMV. And we assume that this entire 50% has come from third-party sellers. So as a result of that, in scenario 2, the percentage of third-party sellers is even higher than the percentage of third-party sellers in scenario 1. And look what happened to the net working capital as a percentage of the total GMV. So effectively what's happening is a higher percentage of third-party sellers is actually making the net working capital even more negative. So to summarize, here A is the net working capital as a percentage of GMV in the existing 2017 situation. B is the net working capital as a percentage of GMV if all sales come only from third-party sellers. So we are seeing that in that situation, the net working capital as a percentage of GMV is a lot more negative. It's 3.72%. So obviously, if we mix that with the existing figures, it will it will make the net working capital even more negative. So a shift from year to year with the increasing percentage of GMV coming from third party sellers would mean that JD will release more amount of capital and the cash flow situation will improve even further. Now, this is an insight which I got somewhere in the middle of 2018, which has been a bad year for JD. So JD's 2018 cash flow was actually not good. JD has been hit by one-off items. But I somehow was convinced that this is bound to play out. And that's exactly what happened in 2019. So in 2019, the percentage of third-party sellers on JD's platform became even higher, and as a result, the net working capital became even more negative. So JD did manage to release even more cash because of that. So I actually felt vindicated, having developed this insight in 2018. The next insight is the depreciation and amortization expense. Now, JD has a very high amount of intangible assets, and this figure shows that they have a gross intangible asset of about 6 billion RMB, which they're carrying on their books, and this is for the strategic cooperation agreement that they have with Tencent. You would know that Tencent is a large shareholder of JD. They own almost 20% of total JD's equity. So effectively, what this figure stands for is, because Tencent and JD, they cooperate strategically, so that is reflected as an intangible asset on JD's books. However, this intangible asset of 6 billion, JD has been amortizing it over a 5-year period, and every year their income statement gets charged by about 1.2 billion renminbi. Now just think about it for a moment. Tencent is a large shareholder of JD, and apart from this strategic cooperation, they also have a business cooperation where they have marketing arrangements where JD pays marketing dollars to Tencent and vice versa. So, that cooperation is completely separate. Now, what do you think are the chances that in April 2019, when this 5-year period is over, Tencent is not going to have any more strategic cooperations with JD? Now, is it possible? Yeah, it's possible, but I think it is very, very unlikely considering how much of equity interest in JD Tencent owns. So, I remember Warren Buffett has touched upon these kind of amortization expenses. There are certain amortization expenses which are very real, and they should absolutely be expensed. But often companies have amortization expenses like they're amortizing their customer relationships, or they're amortizing their distribution network, which they have been carrying as an intangible asset. Now, this is a completely meaningless exercise. So if I just focus on the GAAP earnings, then, the figures look pretty bad. In fact, even in 2018, the figures look pretty bad. But I really don't think that this should be an expense at all. So in my back of the envelope calculation, I will add back this 1.2 billion renminbi of amortization expense. And I think that's the right thing to do. So, these are some different insights. If you study a company very carefully over the years, and if you dig really deep into their financial statements, you realize these hidden sources of value. And somehow, based on these, my conviction for JD grew over the months. And in 2018, it seemed that their world was falling apart. I kept on accumulating, and I had sold a lot of put options. Many of those also got assigned. So JD as a percentage of my portfolio has significantly gone up. And as you can imagine, I have been very handsomely rewarded in 2019 because of this. So, it's possible for you also to gain these kind of insights on the businesses if you look deeply enough. And this is exactly what we teach in our flagship course, which is the Investing Fundamentals, Financial Statement Analysis, and Business Valuation course. So I would encourage you to register for that course. The registration window is open, and we discuss lots of case studies, and we actually look under the bonnet to find these kind of insights, which in turn enhances our conviction in these businesses. And that is how we differentiate ourselves from the other offerings in the market. And before you register, do make it a point to scroll through the course curriculum on moneywisesmart.com/courses. We have published the detailed course curriculum, and there are several preview videos. You'll get a very good idea of the level of depth that we go into, and you'll realize that this is a very, very comprehensive course which starts from the basics and goes to the advanced concepts, which will make you an insightful investor. And we would also like to share what our other registered members are telling about us, so do give it a read. Once you register, you will have a lifetime access not only to the full course, but you'll also have free access to all the supplementary material, videos, and documents that we will keep adding based on your feedback, based on what you ask us to focus on. So I think it's a fantastic offer. And I also invite you to join our Facebook group, which is the Investment Forum. You will benefit from lots of interesting discussions on high quality businesses that go on in that group. And we also from time to time post free videos discussing our research on certain companies as well as certain investment concepts. So thank you very much for your time, and do not forget to like this video and do subscribe to our YouTube channel. Thank you very much.